So as usual, right, we're probably not gonna do any trading. I don't like to enter position before FOMC. But we do have Etsy earnings coming up after tonight. And then tomorrow morning, there will be Marriott earnings. I kind of like want to play Marriott like that. It is back at this level. Mainly also due to the fact that Airbnb actually dropped so much. But let's go through one by one. Okay, let's go through one by one. Firstly, let's discuss what is my outlook. But usually outlook for FOMC doesn't matter one because market tend to get a little crazy. But nonetheless, it's good to go through some new data that came in and a bit of fundamentals of what's going on and some stuff that other central banks are doing. Okay, so first thing first, we have Eurozone inflation went to record high at 10.7%. Okay, and not only that, ECB came out and say that now the ECB like trying to sound like Jerome Powell like that. They say they're gonna be maintaining that aggressive high. They're gonna like keep it at high level, must bring the inflation down, blah, blah, blah. So this one just came out very recently on only October 31st. So this set the tone now. Okay, I do believe this set the tone that, okay, if ECB gonna remain aggressive there, most likely Federal Reserve is gonna probably remain aggressive also, probably. But the more important one is that yesterday, right, there was the JOLTS report. Where's the JOLTS report? Oh shit, we are already at 1 AM. Okay, so this week, there was a JOLTS report that came out here, JOLTS report, and it was considered very good. That there's still a lot more job. So if you remember what Jerome Powell said during the previous meeting, right? It was quite a while back, way back in September, about 2 months ago. Jerome Powell said that in order to do a Fed pivot, right, he will want to see softer job market. This job earning report is definitely not a sign of softer job market. And in fact, last month NFP, the unemployment rate came out and it went down 3.5%. So it went down back to like all-time low like that, 3.5%. So based on what the job reporting is and what the last month NFP is, right, it does seem like the job market is still very strong, still very tight. So it's not a sign for, it's not really a sign for Fed pivot, but that's my personal analysis, okay? So, and of course, that is also based on what Jerome Powell said. It's not what I think or what I feel is from Jerome Powell's mouth, if you were here during the September FOMC. So based on those two criteria, right, it does sort of points towards the not Fed pivot side, non-Fed pivot side, but let's also look at the SCP. Okay, SCP is very important, and SCP is something that no one's look at, nobody look at, and it's funny how a lot of people who don't look at the SCP is like making a lot of bold comment like, oh, Fed pivot, this and that, a lot of nonsense also. But let me bring up the SCP again. The FOMC website September projection material, which is your summary of economic projection, SCP. Okay, so this was in September. The next SCP is going to come out in December, so we won't be seeing any new update on this summary of economic projection later, okay? The next one is in December. So, which means to say that the September one is still in effect, meaning September, the federal fund rate projection is 4.4 for this year. It's already set in stone, 4.4. So whether like Federal Reserve do 50, if Federal Reserve do 50 now, they need to do 50 in December. If FOMC do 75 now, then they need to do 25 in December. If Federal Reserve do 25 now, then they have to do 75 in December in order to meet this 4.4, because currently we are at 3.5 right now, correct? So it doesn't matter like now what they do lah, because at the end of the year, they are targeting 4.4. Unless for some reason on December itself, the new SCP that come out, right, they revise this rate again. That is another issue lah. But until then, right, we don't really have any data. So we are just basing on September data. Okay. So that is what I meant by it doesn't matter 25, 75, 50. This year is set in stone already. What is gonna drive the market is not today, later is going to be 25, 50, 75. Usually people who believe like, oh, later 50 market rally, later 75 market crash is like they have no idea of what's going on. They are just playing the 50-50 game and then sprinkling a lot of air quote fundamental into the analysis. But it is important that we need to really project like when we are projecting something, right, we know what's going on. We know what goes into the consideration and all this. And of course, we have also looked at the unemployment rate last time, and the fact that for 2023, right, the unemployment rate projection is to 4.4, which means Federal Reserve really want slightly higher unemployment rate. I mean, it is wrong to say that Federal Reserve want people to lose job. But I mean, that's what they want lah. Because in order to bring inflation down, people need to lose their job. That's the unfortunate reality. And this 4.4 is saying they can tolerate unemployment rate of 4.4%, meaning they don't mind keeping the inflation at a very high level. And if unemployment rate goes up from 3.5 to 3.8 to 4.4, 4.0, they don't mind. They can tolerate until 4.4. Meaning, if the unemployment rate is still at 3.5, right, they are not gonna ease. They're gonna keep up with that aggressive rate hike. Okay, so that's one thing that we learned from the last round of FOMC. Also, of course, if this round, if Jerome Powell kind of like change his tune, like suddenly he say, oh no, like I think stock market diving already, or like I think we should go a little softer now, then that one is a different story lah. But of course, what kind of tunes Jerome Powell is gonna be like, is he going to be hawkish, dovish? We don't really know lah. It is not to say that those who are expecting a Fed pivot, is not to say that they are wrong, but most of the analysis being used to project a Fed pivot is wrong lah. In a way, at the end of the day, right, it is still 50-50, so we can do all sorts of projection we want. We can make all sorts of bold prediction. In the end, it is still a 50-50 lah. So it doesn't really like sort of, how should I put it? Yes, you can still get your prediction correct, but it doesn't mean that how you get there is correct. So aside from that, right, there are other indicators also, in a sense, from the 3-month government bond, right? Recently it has been spiking up in this week. It kind of tells you that usually when 3-month bond, or even the two-year bond, when it tends to spike up, right, it is a clue that the bond market themselves expect a higher rate hike. That's why they are pre-spiking, especially the two-month yield and the 3-month yield. The 2-month actually, sorry, not 2-month, 2-year yield. The 2-year yield actually recovered quite a bit from this initial sell down. Even the 10-year yield kind of rebound back yesterday. So we do have the bond market kind of like preemptively spiking up before the FOMC, which is not usually a good sign, not usually a good sign, because when that happens, right, we do have the Federal Reserve sticking to their aggressive tone in terms of rate hike. And we can actually see that back in like July, August period, because you remember when June, right, when market went down, when during June, you can see that the market actually rallied, June bottom rally until August 15, correct? August 15 like that. Then after that, it create a lower high and then it break through all the way. And if you look at even on the technical side, right, it broke through the previous low here, and then it even broke through the resistance, broke through the previous support before it slowly turned. And right now, it seems like we are facing that kind of situation again. We broke through the previous low, we broke through the resistance, and it is now at the so-called previous support level, and it's now giving this kind of funny price action again. So it is in terms of technical wise, kind of like a bit scary, but of course, we can also have a situation where market can rally on FOMC, goes up, and then later, like later this Friday, the new NFP data come out, and then next week another CPI come out, then it just go all the way down. Then you still have a lower high here. Okay, so if it rallies, try not to celebrate too early and then suddenly like, oh my God, FOMC pivot, and then wow, all in ready, bottom ready, and then when the CPI come out, you get caught with your pants down. It's very common. In fact, it is like almost like written in the stars like that. Okay, so that's one thing. That's why I'm remaining neutral for now. The only reason why I do not want to go net short is because the price action is too aggressive. I will definitely go net short once more data are out. Okay. And on top of that, right, the fact that market rallies into FOMC, I don't really like it also, because it can also be that Federal Reserve does a 50 basis point high, which everyone thinks 50 basis point means Fed pivot, but it can do a 50 basis point high, but market still go down. Because why? Prior to that, it rallies already. Imagine if market did not do this rally. In fact, this rally have no substantial reason, there's no justification behind this rally at all. Mainly because back in previous rate hike was here. Back when previous rate hike until now, right, there isn't any positive thing to justify this rally. We have NFP that is very hot. NFP, the unemployment rate here, very hot. The CPI was quite hot also. It was above the expectation, but during this period, we were a little bit bullish because market pre-crash. But beyond that, right, like around beyond this level, beyond 3007 level, right, the market have no reason to rally upwards. Considering the fact that the big tech's earnings were quite bad and market rally against the bad big tech's earning, it is like the market is going all in on the Federal Reserve Fed pivot, and then end up later they read wrong again and then gonna slapped by Jerome Powell. Okay, so we have to consider that also. So imagine alternate reality where the tech earnings are very bad, market crash until here, then it like ding dong here, and then we go into FOMC with the market at the low. Then if that's the situation, right, I will be a little bit more bullish. I'll be more bullish because even if Federal Reserve raised by 75 basis points, right, it can still rally. But now we are already at this level without rhyme or reason. We are defying gravity to rally with the whole delusion of the Fed pivot coming in. Okay, so that's practically what I feel right now. But whether or not market gonna rally, I think it will still largely depend on what Jerome Powell says, not the number itself. Okay, the number doesn't really matter. So we are now awaiting the numbers and the the press conference itself. But let's take a look at some of the pre-FOMC movement. First, we actually have Intuit jumped down 7% yesterday, which is kind of good because yesterday post-holding was kind of like positive. Today post-holding go down a bit, but still post-holding is doing very well at the high there. And the fact that Intuit jumped down 7%, right? It makes the spread very nice. Like the spread went back to positive. And Dillard is like down 2% from the top, but it's still a long way. So personally, I'm still going to hold on to Dillard, but important one is SC, okay? SC actually broke through the support already, and it has also broken through $90. $90 is my strike price, so now I am totally dependent on the earnings. If the earnings back, SC gap down, then definitely my option's gonna be in profit. If it gaps up, then of course, wait until the option expire, then see whether any miracle happens or not. Apple kind of like recovering. Just now it was like all the way until 148 like that, but now at 149. But you can see that Apple did not went beyond the earnings high. Okay, so as mentioned, Apple earnings is a little shitty. It's not very shitty like Google like that. It's a little shitty, but it doesn't justify this amount of rally. So there's a very big difference between fundamentals and technical. Technical folks will see this, and then after that, they will support the technical with fundamentals, say, oh, Apple beat this, beat that, that's why price up, so can long. But if you truly know fundamentals, you will know that, okay, the fundamental quite bad, but the rally is not justifying the fundamentals, so I'm gonna wait for a good opportunity to short. That is using fundamental first and then waiting for technical to align. And that is precisely what we did here. And that is also exactly what we did with Facebook short also. Okay, so the funny thing is right now, I do think that Facebook is about to like hitting the bottom soon. You just need the fundamental to sort of align with it. We just want one quarter of Facebook where the earnings recover, and then Mark Zuckerberg to say something positive, and then Facebook can go back up. But right now, what happened is that all the technical folks are now like, oh, Facebook is bad fundamentals now simply because they saw the big gap down here. So it is a very big difference. You can see like who are the technical first and then sprinkle some fundamental nonsense and the other way around. So it is very important to distinguish, because if you blindly believe that, oh, this fundamental good, and then you start back holding the whole thing, right, you might end up with like a very back holder end up you hold the stock until I don't know how many years, then the thing go red and red and red. Or you may miss out a true bottom pick, that kind of situation. Marathon Digital, -6%. So I'm gonna repeat again, okay? If you want to take the profit and run now, which you should be in a good substantial profit, it is okay to run, simply because we don't know how the FOMC will go, and slightly later FOMC like erase all your profit and then you are gone, your profit gone for good. Okay, so since we are already in a substantial profit, I think it is I would say advisable to lock the profit. And I have already run. I have already locked my profit. Okay, I took my profit on Marathon Digital already. I'm not gonna hold beyond the FOMC because initially it was like -3%, but I saw it go down right now to -6, right? It is in a very, very good profit. So I'm gonna zao first . Okay, so Amazon went back down to below earnings also. Quite sad because I actually TP Amazon here . If I follow my initial plan of holding through this way, then I may have gotten a lot more profit, but it was a last minute trade, and it was I would say a bonus profit that wasn't planned . Okay, so I'm gonna take whatever I can get. And Rumble starting to U-turn back down also. So maybe we can play Rumble again. We can play Rumble put option again. We shall see how. Okay, we wait for FOMC to over. Rivian also seems like U-turning back down. So once again, this is the difference between fundamental and technical, is that yes, Rivian fundamentals sucks. Yes, we took the short here, we got exited bad, but this short position being stopped out at this level, right? It doesn't change the fundamental at all. It is still very bad, and I'm probably gonna look at another opportunity to reshort again now. Okay, and I think currently this is a good opportunity. If today was not a FOMC day, right, I might actually retake the short again, or in fact I might do a spread trade with Autodesk. But since FOMC is like a few minutes away, like 15 minutes away, so might as well wait for the FOMC result. Another one is WWE, once again defying gravity, still quite positive. We also have Zoom Infotech dropping 26%. No idea what's going on over there. Spotify also dropping quite bad. Aside from that, PayPal is quite okay, but Netflix start to U-turn back down already. I'm hoping somewhere here, but I think it's U-turning early. Still early to say though. I don't want to short this and then it goes up like that and then come back down. So this one a bit still too early lah, still too early. But Marriott, I do kind of want to short Marriott also. So Marriott watch list, Rivian also watch list. Apple, do I want to retake the short? Maybe I may want to retake the short, but let's see how lah. Okay, because we have SC earnings coming up, so let's get SC out of the way first before we start like taking a whole bunch of new shots lah. Okay, let's look at how is AIG doing. I think AIG earnings came out already and it was okay lah, so lah. Let's look at other watch lists. Today seems like energy is down. Is energy down today? No, it's the energy counters are up. Bitcoin is also up by a bit. I'm not sure why Marathon Digital down so much. The yields are retracing a bit only. It is not a big retrace. It's only a bit. So shall wait and see how. But S&P kind of recovering from the bottom lah. Okay, let's look at other stuff. We do have AMD and NVDA. AMD earnings was missed a lot of stuff. Then today gap up, but come back and then it came back down. It looked like want to rally like that, but suddenly it's coming back down. Then again, who know after FOMC what's gonna happen now? Okay, but one thing you'll notice about AMD is like it's been stuck within this two price for such a long time, and it's very volatile. Like go all the way up like +6%, +7%, and then suddenly one pin bar come down and then gap up again but close down, and then after that engulfing and then stuck there. It's like between this price level for so long already. And of course, if you want to look at it in another way, right, it is just hovering inside this range lah. Okay. Nvidia more like at least is still going up. So Amazon we went through already, it went further down. Google also still a lot of weakness over there. Actually, Google earning is like I was surprised by Google's earning also like that. It is able to miss everything, every single estimate miss, even after so many rounds of estimate being revised downward, it still managed to miss lah. Meta at this stage, right, I probably will not be too bearish on Meta really. I'll just wait for any form of positive catalyst to sort of U-turn this thing lah. Okay, Tesla also coming back now after the gap down. So for Tesla, right, the earnings is not really that spectacular. The growth is very strong, but the earning is like, I mean, this share price, the PE ratio, the share price of Tesla has already accounted for that aggressive earnings growth lah. Okay, so if the earnings growth is declining, right, it is quite possible that Tesla may break through 200 and go further downwards. So I'll probably will want to long Tesla somewhere around like 120, 100, somewhere around there, around this level here. So I think this is a good place to like wait to buy Tesla also lah. Coinbase recovered a lot. No, not recover a lot. Last few days it was down a lot lah. CrowdStrike coming down, and then Snowflake also coming back down from this level. Rivian, Wingstop, how about Whirlpool? Whirlpool also like hitting the previous support level, sorry, the previous resistance level. The finance sector is doing really, the finance sector is actually quite resilient though. Bank of American Express, Bank of America went all the way up, and then Citigroup like rallying quite okay. Goldman Sachs all the way up, JP Morgan all the way up, even break through the resistance. Oh my god. So I do think that for the entire earnings season, right? The October earnings season, it is the finance sector that is holding up the S&P lah. So if you look at overall index in general, right, S&P still able to rally a bit, but you see Nasdaq is very lagging behind. Nasdaq wasn't able to break out of the resistance mainly because Nasdaq is full of tech companies lah. And the only time it was able to rally quite substantially is on the day where after Apple earnings, then we have that huge 4% rally on Nasdaq, but aside from that, it is still at the resistance. So this round, Dow Jones rally the most because we have companies like McDonald's and Coca-Cola all rallying very high, and Dow Jones itself is not really tech heavy lah. So you do have Dow Jones rallying a lot. S&P kind of like so-so, but Nasdaq is the one that's lagging the most. DBS UOB actually did very spectacularly well, and because of that, DBS also went up. So I don't think that DBS, if it does well, right, is gonna have any steam to rally higher. You already pre-rally based on UOB earning lah. So normally you will tend to see this kind of behavior in similar sector where when Visa have good earnings and rally, right? When Visa have good earnings and then rally all the way up, MasterCard also rally all the way up. And then after MasterCard earnings came out, right, it did not rally so much really because on Visa earning it has already rallied a lot. So depends on how good is DBS earning. What's the time now? Okay, 52 minutes. Soon. Okay, soon, 7 minutes. And then after that, we, of course, after number come out, doesn't mean anything. Market will definitely fluctuate a lot, but it doesn't mean anything lah. So we have to wait for FOMC press conference at 2:30. So as usual, we'll be watching the whole thing, and then I will try to pinpoint certain in-between messages, you know, that Jerome Powell like to say. But one thing I want to warn about FOMC decision also is that it tends to go in the opposite direction first, and then after that it tends to goes in the other direction. So if you are bear, right, you may want to see a rally first. Then after that, it will go back down because usually it will always end up in the other direction. I think almost every time. Wait, when was the... Okay, this is the Jackson Hole. This is the CPI. And I believe this is the last FOMC. Okay, so this is the last FOMC. Look at this. Initially go all the way down. After that went up. Then after that went all the way down. Okay, so if you are a bear, you want to see a downward first. But when it rally, right, you don't panic, you wait for the other down move. But I'm just joking, like it doesn't always happen like this, but you will definitely see very big whipsaw. So don't go and make trades during this period, okay? You are bound to get whipsaw. Okay, let's take a look at dollar also. How's the dollar doing? Dollar kind of recovered. Not bad. Recovered a bit recently. Dogecoin rally during weekend. Recently I saw iron crash quite a bit. Recently I saw iron crash quite a bit. Usually when iron crash, it's like a sign of major economic slowdown. Of course, it already crashed so much, but the fact that it is still crashing, not a good sign. Not a good sign. It broke the trend already. It kind of means that the economic slowdown is going to be even worse. Copper is still doing all right. Lumber, no, I don't want this lumber. I want this lumber. Lumber also broke through this support level already. ARKK down a lot. This morning I wanted to, because recently you guys saw the news about the Russia going back on the Ukraine port and then all the nonsense. Wait, let me go and Google. Russia, Ukraine, we. Oh, okay. It allowed the deals to resume. so much things happen within such a short period of time. Russia U-turns allow grain deal to resume. Initially, like just during the weekend, like Monday, like that, I saw Russia do something funny that they are trying to shut down the port, and then after that, wheat ran up, but this one was because I saw that news and I was saying, maybe wheat can buy, and then today I look at how come wheat is down 5%? Then it is because of this. You turn so fast. You should rank Mera at 2.03. If 2.03, it means close to 100% already. It means close to 100% already. I didn't get 100%. I think I got like 80%. Hey, it's still down a lot though. It's still down a lot. It's still down a lot. 6.71. You bought at 102. Yeah, I mean you bought at 102, you run at 2.03, almost 200%. Almost 200%. Yeah, great. For those who ran, right? Yeah, it's considered for a YOLO run. I mean, yeah, it's not 300%, but I mean, it's rather to take the 90 than to gamble whether you lose the 90 or you like want to continue to gamble, okay? Oh, you bought at what? That one is like going 300% already. Congrats. Nice. Because I do remember after we buy, right? I think Marathon Digital went up a bit higher. Then after that, it just go all the way now. I'm quite happy lah. It kind of like give me the profit that I should have gotten more for my Amazon. Good enough. Yeah, as I was saying, back in the week, right? Yeah, I wanted to long week, but suddenly this U-turn make me feel like so the issue with commodities is that it's too it carries this geopolitical risk that is almost impossible to predict. So you can do a bunch of analysis and then everything is just like useless because like something happened like that. Never average down, never ever average down. For trading, for YOLO stuff, never ever average down. I will never average down a losing position. I will double down a profit position, but I won't average down a losing position. Okay, 1 minute. Thank you for the thank you for the time check. Okay, expectation 4.0, so it's 75, 0.75 lah. Okay, 75 basis point. Okay, let's go and do a 1 minute chart. The crazy. Not so crazy, considering it's only 11 seconds away. Not so crazy, it tends to be a lot crazier. Hey. Number. Where's the number? 4, 75 basis point. This movement here doesn't matter. This movement here doesn't matter. Let it do whatever it wants, and then later Jerome Powell's speech we will know lah. Actually, this I don't consider this crazy. I don't consider this crazy. This is actually quite muted because we are looking at 5 minutes chart, right? For example, you look at this movement. You look at this, and this movement is during pre-market hour. And it's like almost similar lah. So in fact, Dillard is not part of S&P lah. So Dillard movement don't really correlate with S&P. I don't think this is considered a very big movement lah. Yeah, actually, I'm kind of like tempted to short when it is going up this high. Later, Jerome Powell speak, like everything start to come back down. Okay, so once again, this movement doesn't matter. We wait for Jerome Powell's speech, okay? SC went green. This spotting good. There's no movement in this. Dillard also a little bit no movement lah. But Dillard usually Dillard is it doesn't correlate with S&P a lot lah. But we do have Apple going green. Marathon Digital recover a lot. Yeah, I mean, I say I'm tempted to short, but I'm not I'm not going to short lah. I'm not going to short now before the what do you call that, the press conference. Oh yeah, I wanted to talk about Sketcher. Sketcher actually went back up, but I'm perfectly fine with this. I'm still continue to hold my shorts lah. I'll just stick to my initial trade plan. Yeah, so if you look at it on a daily time frame, right? It doesn't seems like a big candle lah. I mean, if 1 month later you look back at this candle, right? It seems like like anything happened this candle, man. At least you look at this and this, you know something happened. What's the SPY? Can you to shop? You want to shop Mara again? Hey, wait. Let's look at the yield. Okay, the yield went down. The yield went down. The yield. Look at the yield. What's the SPY? What's the SPY? IV What's the SPY IV right now? Let me just check. It look very tempting. It looked very tempting. $204. Sorry. Third. This week, fourth, 11. Next week is 11. Okay, 11 put option for SPY. IV only 29%. IV is only 29%. Huh. Okay, we wait for the press conference. We wait for the press conference. Bitcoin went up. How's the dollar? Dollar went back down. Yeah. We wait for press conference. Okay, FOMC statement is out. Hey, bluff people, never are that okay? Let's read. Recent indicator point to modest growth in spending and production. Are you not good already? Job gain has been robust in recent months. Unemployment rate has remained low. Okay, not good for Fed pivot theory. Inflation remained elevated, reflecting supply and demand imbalance related to pandemic, higher food and energy prices, and broader price pressure. Russia's war against Ukraine is causing tremendous human and economic hardship. The war and elevated events are creating additional upward pressure on inflation and are weighing on global economic activities. Committee is slightly attentive to inflation risk. Committee seek to achieve maximum employment and inflation at a rate of 2% over the long run. In support of these goals, committee decide to raise target range for the federal fund rate to be 3.75% to 4%. Okay. Committee anticipate that ongoing increase in target range will be appropriate in order to attain the stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So the keyword anticipate that ongoing increase, okay, meaning it's telling you they are still gonna going to increase. In determining the pace of future increase in target range, committee will take into account of cumulative tightening monetary policy. Look at this. Which lags with monetary blah blah blah. In addition, committee will continue to reduce its treasury holding, treasury security and agency debt and agency mortgage-backed security as described in the plan for reducing size of federal balance sheet that were issued in May. So they are still continue to reduce the balance sheet by like quite a bit or whatever they plan in May . So there's no plan to sort of slow down on the balance sheet reduction yet. So yeah, nothing changed. They will continue to raise the rate. and they will continue to reduce their balance sheet. So right now, it's already at 4%, right? So if it's already at 4%, in order to achieve the projection, the SCP, right? 4.4 here. It is highly, I mean, it is almost confirmed guaranteed chop. December 1, right? It's not going to be 75 already. Okay, it's not going to be 75 for December 1 already. Unless in December, they last minute project this higher also because maybe November CPI suddenly shoot up very high, that kind of stuff. We don't really know also lah. But with all the current data that we have, most likely December probably gonna be 50 basis point lah. Okay. So it's like it's already quite clear cut like that lah. And then if later like people come in, oh, like we think December gonna 50 basis point, it's like the same as saying the sun will rise in the morning lah. So it's not much different. But of course, in December, right, when the new SCP come out, the next SCP is coming out in December, and they change their projection again because November CPI is very high, then that's a different story lah. And December FOMC meeting is on the 13th, 14th. So this one quite hard to say whether is it before or after the December CPI. Most likely I will think is before. Or on that day itself. Because CPI usually come out on Tuesday, right? If I'm not wrong. Yeah, correct. Our Apple put option need to close tomorrow. So do remember to close long. But I'm still gonna like get like cross finger on today price action. But it went to 151. It went back up to 151. It's coming back down again. Wow, today Apple quite volatile. From 148 go all the way to 151. In fact, the strike price was, what was the strike price? I forgot already. I got too many Apple options. 148, yeah, strike price of 148. So I was thinking if today can close 148 and then tomorrow go down a bit more, right? Maybe can salvage a bit lah. But once again, we see what's Jerome Powell press conference lah. Now it is retracing quite substantially really. Just now it was like plus 1%, now plus 0.4%. Yeah, it's the usual nonsense lah. It's the usual nonsense. SC back down to red. Oh, actually SC quite correlated with S&P. Oh, Royal Gold went up. Wow, look at that. Did gold went up? Where's gold? Where's my gold? Oh, gold went up quite a bit, almost 1%. Okay. Yeah, but close tomorrow. Close tomorrow. Yeah, so that's, yeah, I mean that's the same thing, that's the same thing. I mean they are going to hit their 4.4 soon. They are going to hit their 4.4 soon, which means December will probably be another hike, but it's not going to be 75, it's going to be 50. And then in 2023, right, there will be one more. Most likely in January, there will be one more, which is 25 basis point. So it will be like December 50, next year, Jan 25, and then they will pause. So it is like saying the sun will come out in the morning. So it's as if like it's nothing that we don't already know based on the SCP projection. But you have to think about what is actually a Fed pivot. If you are saying that there's gonna be a Fed pivot and you think that the Fed pivot can send the market back into bullish mode, right? Then what you really want is you want Federal Reserve to start reducing the rate and then start slowing down the pace of their balance sheet reduction. If the balance sheet reduction remain that aggressive and then they are going to maintain the 4% rate for the entire of 2023, right? That is not a Fed pivot. They simply just reduce the rate high from 75 to 50 with accordance to the SCP. That's basically what they did. It is not a Fed pivot. And if you look back in history, since 2008, right? Look all the way back to 2008. For how many consecutive months where Federal Reserve actually keep the rate at like this high for a prolonged period of time? There wasn't any situation there wasn't any instances where they did that. Normally they hike until the peak ready, and then like 2-3 months later immediately reduce back because the market is throwing a tantrum. And then back then, right, they can do that because inflation is like less than 1% or less than 2%. But now it is a whole different story. We have to account for a prolonged period, which is like the entire of 2023, where the rate is at above 4%. And then in entire of 2024, right, the rate is at 3.9%. And that is not a situation that market can reliably rally. On top of that, you have the balance sheet reduction. You have the balance sheet reduction taking place. So the entire Fed pivot thing to me is like, if Federal Reserve pause the hike and retain it at 4.6, right? That's definitely not a good news at all. That's not good news at all. It will probably cause the market to go into a like more of a stagnant mode rather than rally mode. It may go up, and then it will come back down, and then go up, come back down, and then after that it will just like this kind of pattern where you don't really see, or maybe more clearly this kind of pattern. Then you have like the entire year like 2015, 2016 like that. Like after 2 years, right? After 2 years, you are only up by like 3% like that. You will go into that kind. Okay. This rally was done with zero rate, unprecedented QE, where they bought unlimited amount of treasury and MBS bond, and now they are reducing the rate and they have no intention to stop the rate of their balance sheet reduction. So even if they pause, right, it is not the kind of environment where your growth tech stock can rally, your Apple can rally, your Google can go back all-time high, Amazon can go back all-time high. I think that is not the kind of environment. Okay, let's pray for Apple to fall. Okay, Apple back to red. Nice. Halfway there. Okay, guys. I'm going to. Sorry, I'm reading news. I'm going back to washroom again. So sorry. Last few days, like consecutive dinner outing. Because of a lot of birthday happening within October, and then eat too much. I'll be back. Okay, so just stare at Apple for a while, or stare at S&P for a while. Okay, I'm back. Anything going on? Haven't started yet, but soon. What's the time now? Okay, 6 more minutes. 6 more minutes. Oh, Intuit actually went back up. When is Intuit earnings up? I do want to hold Intuit through the earnings. Still so far, 29 October. I have to hold post holding at Intuit until 29 October. Lucid up 4%. How about Rivian? Rivian recovered. Starbucks. Oh, nice. WWE up 0.6. How's Dillard? Dillard is slightly red. Not red enough though. This one, soon. I really don't believe that I really don't believe that this one is gonna go back to 400 level. It's like it's defying all logic. Okay, so normally the kind of action you see is something like this. Once the number come out, right, it will just go shoot in one direction. Then after that, it will kind of like hang around until the press conference lah. Then after the press conference, during the press conference, it will up down also. But after that, the market digests a bit and then the direction become clear lah. But one thing that is a little bit scary now is that because the FOMC is just before the NFP, and then it is also before the inflation number, right? So you have a lot of high impact data crammed together within such a short period. It can get very crazy lah. I think there was a period in, I think it was last season, if I'm not wrong, we actually have inflation data, and then FOMC, and then Apple, Amazon, Google, Microsoft earnings, like all within like 2 weeks, and then everything is all over the place. And the price action are like crazy. Strike. How come got gap up in the middle of nowhere here? Plug power actually was down quite big. Oh wow. Okay lah, not that big lah. My plug power option expiring on the 18th. I'm gonna hold till expiry lah. But my plug power already up 300%. But that 300% is meaningless because I only got like $300. Snowflake. Anything else? Oh, the banks are shooting up very high. No wonder the S&P up so much. Maybe in the future, maybe we play triple Q instead. Because usually when you want to short, it's always the tech sector and then the finance sector start to go against the tech sector, and then we get that kind of nonsense price action. Hershey at all-time high. Hershey is like steady from PPs. General Mills also doing quite okay. How about Walmart? Slowly creeping back up. Target, Target still a bit quite weak. Adobe recover 2%. Sorry, Airbnb. Adobe also quite weak. Don't know can close the gap or not. Bill holding. I always want to short bill holding, but a bit hard also. CVS Health. Cloudflare recovered a lot. Just now it was down like 6%. Has it start? Oh, want to start now. Wait, let me share the audio. Online.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy. and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we're seeing we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has He has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to to see the path, it's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. You know, again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And you know, our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Okay, guys, a lot of new information, a lot of new information, but I hear what I want to hear already lah. After that, I'm kind of like zoned out already, and the one that I want to hear was premature to think about pausing. Okay, that's the only takeaway you need from this. It is premature to think about pausing, meaning December, they're going to hike, doesn't matter, 20, 50, 60, doesn't matter, whatever, they are still going to hike, okay? The number doesn't matter, the number doesn't matter, it is whether or not they are consistently going to hike. Definitely, at some point, they will slow down the speed, meaning, of course, they cannot always 75 lah, but the fact that they slow down from 75 to 50, right, it is not an indication of market rally. It is not an indication of Fed pivot. It is not a pivot. Pivot meaning you U-turn. U-turn meaning you reduce the rate, not pause, not lower the speed, but you U-turn. Okay, so that is not going to happen anytime soon. So you can see how aggressively when market shook back down the moment he say premature to think about pausing. Initially, it was like all the way up 1%. The moment he said that, it just like shoot all the way down. So, I mean, this is something that is like, yes, we talk about federal rate FOMC 50-50, right? But if you use like a bit of logical thinking, you sit through what has happened, what led the stock market until this price, what is the data that incoming in between all this, right? You can kind of like have a rough expectation. You can sort of like have a roughly accurate rating, maybe not 100%, but maybe 60-70%. And over the long run, right, you are going to make a lot of good decision making, and then and you will be able to like make a lot of trade action out of such decisions. So for example, now it does seem that price market is gonna go back down because now there's reason to go back down. Previously, there was no reason to go up. So we do have all this kind of stuff coming in now, okay? So there's no point in randomly calling a bunch of random numbers and then you don't really have any data to back them up. So it is very, very important that you know what you are looking at, you know how you are predicting, you know all your information, where to get them. For example, the SCP is a very, very important guide, and like listening to what Jerome Powell says is also very important, because another thing that I caught during this session that I didn't really, that he didn't mention any other session, is he is looking at inflation month over month, okay, month over month, not the year over year. So most of the time inflation, when we look at it, we are always looking at the year over year. So let me go and bring it up to you. Wait, let me load the page first. So now we have our direction ready lah. We have, yes, also, oh really, did he mention that? Okay, thanks for bringing it up. I think I may have missed out that one, because my head was thinking, what should I short? I wasn't thinking at anything else really. Okay, so this CPI that you see, right, this 8.1, so this is the most common one that we will look at lah. This is, and that number is actually a year-over-year number, okay, year-over-year number. So it is comparing to last year October, last year September, that kind of. So it's a year-over-year number. So year-over-year, you can see July peak and then come back down, and then like it's coming back down. But the month-over-month, right? This is the month-over-month. Month-over-month is still positive. So what Jerome Powell wants is consecutive month-over-month negative. And we have not really got a month-over-month negative yet. The fact that month-over-month is still positive, right, is a very, very bad thing. And the best we got was 0% in August, which Biden was very happy. But after that, we never once had a month-over-month decline since the what's that? COVID-19, okay. So yes, we got our direction ready. Crossfinger, Apple. Maybe Apple can goes into profit now. Now we are kind of like recouping some of the loss already. Okay. What price do we get our Apple? Is it $3, $4, $5? I think the break even is 144 if I'm not wrong. So good chance that we can, holy crap, Marathon minus 9%. Who's still holding Marathon? Oh my god, we should have hold. But I mean hindsight lah. Anyone still ball enough to hold through the FOMC? but okay lah. I mean it's not, this is hindsight lah. Okay, it's not wrong to take the money lah. Okay, I mean it's not wrong to TP the money. Yeah, 90% is considered good already. Okay, we have Rivian down 4%, so maybe we can have a oh wow, nice. May I suggest you run because it should be holy crap. We broke down we broke down 3,008 already lah. Okay, so Apple is going back to pre-earning ready. So this is what I mean by fundamental important. You use fundamental, you align with technical. Not you look at technical and then you throw random fundamental nonsense that you don't even know of. So okay, before I end this session, right, we're gonna probably stick back to short position for now, but once again, don't go crazy, okay? Don't go crazy, don't go like, oh, FOMC, then suddenly you like entire portfolio full of short, because tomorrow there will be NFP, but NFP not important. The one that is important is your unemployment rate, and then next week there will be FOMC. Holy crap, dealer down 7%. Okay, the next week there will be CPI also lah. Okay, so we still have all these new data coming in. So you can sort of like go for maybe net 1 short, net 2 short. Is okay already, but after the CPI come out, then we shall continue to see lah. But I do believe we may going back to the downside, and hopefully, right, we're gonna break this low lah. Okay, we're gonna break this low. There is still one more leg down. I do believe there's still one more leg down, and that one will be the last one. That one will be the last one. Okay, so thanks for coming, guys. And tomorrow, right? Unfortunately, tomorrow. Sorry, not tomorrow. Friday, right? Friday, unfortunately, there will be no webinar on Friday because I'll be in Batam celebrating my entire family birthdays lah. But I will be doing Saturday webinar from Batam lah. So you will still see me on Saturday lah because we do have to make a lot of pivot. Okay. So all the SC holder, congrats to you. Still running very strong. I do hope the earning bombs and then we go down another like 20%. Then I'll be happy for everyone lah. I'll be quite happy that able to recoup back most of the loss lah. Okay. The Amazon continue like it's already like -20 already. I should have helped lah. I should help. Okay, guys. So have a great night. Have a great night. So yeah, things are great for the best. And see you guys on Saturday. Bye bye.